Welcome to the CBP Spring Virtual Conference. Whipfly is proud to be a CBP partner and presenting sponsor. I'm TJ O'Neill, also known as the Thirsty CPA, and help lead our firm's craft brewery team. We offer a full lineup of solutions, including accounting and tax, digital strategies, business advisory, and strategic planning services. Our firm's been working with breweries, wineries, and distilleries for decades. So whether you're a startup or looking to expand, we just might surprise you with a new perspective to transform your business. You can learn more at whipfly.com. Remember, that's Whipfly, W-I-P-F-L-I, not Whipfly. I hope you're enjoying the conference. Cheers.
Hello, hello. Well, you saw a little video there from TJ, the Thirsty CPA. I'm the Thirsty Insurance Agent. I'm Kyle Reiner. I'm a food and beverage practice leader at Arthur Hall Insurance in Westchester, PA. We also have a location in Delaware. So I run craftbrewinginsurance.com. Been doing that for almost 13 years. I am now an agency principal and partner at Arthur Hall Insurance. And just really excited to be here. Hopefully drop some knowledge on you folks. Not the most exciting conversation, right? And people see insurance and they're like, but you need it. Your SBA loans and your landlords, they require it. Your distributors require it. So let's tackle that love-hate relationship between brewery owners and insurance. I love what I do. I love who I get to work with. Hope all my clients love me as well. So let's have this conversation about, what it means to have insurance and why they ask you to do what you do. This presentation is, educational purposes only. It's general, right? We're not responsible for, any of your coverage situations in your policies. Everyone's got different risks. Everyone operates differently. Everybody's in different locations. All right. So there's different laws and things like that. But this is just a general overview, give you a little bit of knowledge, help you understand why people do what they do, why insurance companies do what they do. I work with over 150 beverage manufacturers in the United States. As mentioned, I've been doing this for about 12, 13 years now as an independent insurance agent. I worked in breweries. I've brewed beer. I've always been a bartender and a server growing up. And then my mother did too. I was bussing tables at like age 10. I don't think that was allowed. That's what I was doing. I kind of fell in love with the hospitality world. When I went off to college, I ended up working at a brewery, learned the back of the house, the manufacturing. I love beer. I love spirits. I love entrepreneurs, and I love insurance. So last year I became a partner at Arthur Hall Insurance. Figure if I'm going to do this another, 30 years, might as well be an owner. Gained some awards along the way. 40 under 40 last year, which, just got in just under age 40. I don't think I've shaved since. And, Niche Master, been on the cover of magazine. That was cool. That was, 2018. I was like, 2016. And that was kind of validation, like, hey, you're doing the work and you'll get there, patience. So I think that for everybody, right? Patience, keep putting in the work, even when you don't want to, you're tired, it sucks, do it anyway. Maybe you'll be on a magazine. I'm a certified insurance counselor. So that means that I've taken another 5 or 6 exams. I'm also working towards a certified risk manager certificate as well. So many, many exams, lots of studying on top of your normal, one insurance license. So also life insurance licensed. I've written a number of articles for Property Casualty 360 magazine, for National Underwriter, for Independent Agent, worked with Cape or Not here on the beer and brewing. And, I handle and created the Beer Mighty Things podcast, which is, a podcast that it's a craft beverage library in podcast form. It's what you listen to while you brew. It's what's in your ears as you drink beers. So it's a library. We interview all those folks in the industry who are daring mighty things, doing really cool things in the industry. And if you want to hear some cool, unique, out of the box tips, or you want to know about XYZ topic, that's what I'm doing. We're not talking about beer styles and things like that. It's a beverage business library. So tune in. Today's goal. All right, we're going to clarify the what's and whys of property and casualty insurance in the brewing world. What I've come to find is that, we don't like insurance. We don't like anything that we don't understand, right? So I found a quote. People fear what they don't understand and they hate what they can't conquer, right? So we don't understand it. We hate it. We pay for it. We don't use it. We hate it. We're required to have it. We can't conquer it. we hate it, but you got to buy it. So we only hate what we don't understand. Joe Knowles, another author. Again, hopefully through knowledge and understanding, maybe we can like insurance a little bit. It's like a little bit. What is insurance? So this is kind of where it all stems from, right? Insurance is a contract. When you get an insurance policy, you say, we're going to do this, this, and this. And the insurance company says, we're going to do this, this, and this, right? That's kind of what it is. So that's why when you don't do an audit, when you don't do certain things, they're saying, hey, this is a contract. Okay. You said you would. So insurance is a contract represented by a policy in which the policy holder receives financial protection or reimbursement against losses from an insurance company. The insurance company pools many clients together to make payments more affordable for you. So kind of power in numbers. It's also the benefit of specializing in a niche, right? When I work with 150 breweries and distilleries, there's only so many insurance companies out there that like those companies. So when we work with them, they see, the quality of the folks we work with, and, it helps you, right? Get the best price, get things done a little quicker, maybe get some favors done. Who are we dealing with? All right, craft beverage makers and insurance companies. They're a little different. Craft beverage makers are creative. Craft beverage makers are risk takers. Craft beverage makers dislike boundaries. That's why they left corporate America to go make craft beverages. They're constantly innovating. Insurance companies, not creative. They're regulated. They are not risk takers. They have strict underwriting guidelines that they kind of got to follow, because you know what? That insurance company has another insurance company called reinsurance, and they're up there going, this is how you're going to do it. So there's a couple different levels of people you can dislike. Craft beverage makers don't like boundaries. Insurance policies have boundaries. They're called exclusions. These are the things we're not going to cover, right? Wear and tear, flood, something like that. There's other ways to do those things. While the craft beverage makers are always innovating, insurance companies they're following the rules, right? They got to follow these rules. What do we complain about? What do we hate? This is one of the first things I did when I got insurance. Like, what do we think about insurance companies? What do we think about insurance agents? Right, I'm here to hopefully make all these things likable. All right, it's gonna be hard to do. Insurance is too expensive. It goes up every year. Insurance companies are greedy. I pay for it. I never use it. There's lots of jargon. I don't understand it. It's hard to read. It's complex. It doesn't cover anything. Why am I even paying for it? Oh, and those damn audits. All right, they took my money and now they want more. Sound familiar? I hear it all the time. So what we want to know, and hopefully I help you out here today, is, all right, it's expensive. It's always increasing. We're going to learn how it's priced. Companies are greedy. Well, they're thinking about the long term, right? They want to be here 100 years from now when your kids' kids are, buying homes and brewing beer. We pay for it and we never use it. Well, use it. File a claim. Lots of jargon, right? It's true. In the back of the insurance policy, well, anytime you're reading an insurance policy, if there is a word in quotations, there's a part of the insurance policy, it's called definitions, where they define that specific word and you can get a more clear idea of what that word means. It's hard to read. It's complex. Yeah, it's long. There's no doubt. But it's sections, right? Nobody's really ever taught you how to read a policy. So it's kind of, that Dewey Decimal System. You can't find anything. So you can spend some time doing that, but everything is kind of laid out. Almost there's kind of a table of contents. It doesn't cover anything. So we want to talk about what triggers the coverage. Audits, right? At the beginning of a policy is based on estimates. Here's what we think we're going to sell, or here's what we think our payroll is going to be. And you do the audit at the end to go, well, here's what it actually was. We'll give you money back, or you'll owe. Try to take those items and narrow it down to 4 for the sake of today's conversation. If you're going to CBC, we could talk about them all day. Drink a beer with you. All right. So again, top 4 complaints. I kind of think, right, it's costly. The audits suck. They take time. They're not fun. We always owe money. When we talk about coverage triggers, talk about claims. Coverage triggers and claims go together. So first one up front, rising costs. Everything around us is going up. Okay. The insurance industry is no different. You have cost of materials, cost of goods sold. The insurance has cost of goods sold as well. Right. And those are the premiums. So as I mentioned, the rates go up every year, even if I don't file a claim. Actually, workers' compensation, some of it's coming down right now. So it all depends on the year, all depends on what's going on. We are in a hard market. It started in 2020 before COVID. A hard market means, hey, underwriters aren't as willing to bend on pricing. Insurance carriers aren't as willing to write in certain areas. Insurance carriers aren't offering the limits that they did, right? You might have had a $20 million limit last year. The max they'll do this year is 5 or 10. And you know what? It might still cost that same amount. The insurance industry is trying always to kind of price itself accurately, again, for that long term. So let's talk about beverage manufacturing, okay? As a manufacturer, you're going to be typically, probably 95% of the time, you're going to be based on your sales figures. And now we have sales that are consumed on premises. We have sales that are wholesale, retail to go, consumed off premises. So they have different rates, okay? So what I hear all the time, hey, my rates went up. They go up every year. Well, in this scenario, let's take $500,000 of sales in the tasting room, okay? The rate for that is 2%. So do the math. Your insurance premium for that on-premises consumption, 500,000 sales times 2% rate is $10,000 a premium. Now, 1.5 million in sales times a rate of 2% is 30,000. Okay. So same rate, but your sales tripled. The rate stayed the same. Your premiums went up. Okay. So when we say your rates go up every year, just to clarify, not to be kind of a, snarky, but your rate didn't change. It's still 2%, right? That's the rate for the on-premises consumption. Again, these are all just made up numbers, but your sales increased. So therefore, being a manufacturing company of alcohol, of screwdrivers, of sneakers, you're going to be based on sales. All right. So your sales went up. So therefore, your premium went up. All right. Because it went against the same rate, but your sales went up. Again, based on sales. All right. The question is, are you classified correctly? And this is kind of where it's important to have an expert, somebody who pays attention to your niche. Somebody who can provide value, somebody who can help with an audit, somebody who can go back to an auditor and go, you did this wrong. Okay. In this scenario, say we have 2 million in sale. Let's say we have that 5. Well, we'll go on the next slides, but it's how you're classified. Okay. On premises versus off premises. They're going to have different rates because they have different risks. Okay. So we're going to take this situation where you might have been misclassified. Okay. We had $500,000 of on-premises sales, on-premises consumption. So when you're in your POS systems, make sure that you can delineate between, hey, this person got 2 draft beers and then took a 4-pack home. Okay. So that might be a $30 tab. All right. You don't want that $30 to be considered on-premises consumption. That's going to carry a 2% rate. Okay. So 500 in on-premises consumption times a rate of 2% is $10,000 in premium. Now, you had 1.5 million, right? Those cans, everything going out the door, 1.5 million in sales. So you're a $2 million a year beverage company. 1.5 million in wholesale sales consumed elsewhere, where people are on their couch and not leaving your tasting room in a car, can get in an accident. That's got a fraction of the rate. So where on the prior slide, right? If we go back to the prior slide, $1.5 million at a 2% rate was 30,000. Well, if that was misclassified, then you're paying extra. Okay. It should have been $7,500, right? So that misclassification, because the agent didn't do it right and the auditor didn't know what the auditor was doing. And the auditors, a lot of times since COVID, they are third party, right? So they don't necessarily work for the insurance company. They're just coming in, they're collecting your stuff. They're going to do that multiple times a rate. And that's your dollar amount. Now you can dispute it if it's not done correctly. So in this scenario, all right, say they misclassified it. They did your 1.5 million of wholesale sales at 2%. It was 30 grand. It should have been 7,500. So You paid $22,500 extra. That's more than $2,000 a month. That's real money. That's a vehicle. That is employees. That is new, stuff around the brewery, right? Equipment, technology, things like that, right? It's important to understand how these are classified, and it's also important for your insurance agent to do that. I've had plenty of insurance agents go, hey, I've insured this guy and his family, his home and auto his whole life. He's starting a brewery. I don't know what to do. Can you take care of him? Because it's a manufacturing company. It is a restaurant up front. It's there's multiple businesses within the brewery, right? You have a back of house and a front of house and a wholesale business. It's all different, right? So insurance agents, this is kind of new, right? They don't know what's going on. They don't want to, if they don't, hey, I'll take it on and I'll do it. You end up paying extra because it's misclassified. Okay. So we want to make sure that you're classified correctly. That data is important, that we're able to pull that from the POS system. Okay. These have different rates because they have different risks. Okay. 2% versus 0.5%. You're based on sales, right? Your premiums are based on sales and how they're classified. You're going to pay extra if it's misclassified. Okay. You get that audit, you're like, I don't know, it's going to be due all at once, right? So same thing with payroll, right? If we have $200,000 of payroll and it's in the bartender class code, and states are going to be different. Every state is different. So I'm kind of taking a Pennsylvania situation here. Bartender class code is going to be the least costly typically. Okay. So if you have $200,000, it's at a rate of 1%, divide that by 100, $2,000 workers' compensation premium. Okay. If your employees are classified as a restaurant, okay, and every state's got different rules. Okay. It's usually an alcohol versus food sales, how you're classified. Restaurant grade is going to be a little higher, okay, than bar, right? They think you're making food, you can burn yourself, you can cut yourself. So it comes with a little higher rate. So we'll call it a rate of 1.4. Now that same $200,000 is going to cost you $800 more a year. Not a big deal, but still it's almost 30% more for the same coverage. $200,000 payroll times a rate of a brewery rate, right? The brewery classification, if they put you in that, now it's $4,800. So it could have been $2,000. Now you're paying $4,800. Again, year over year. And as you grow, if being misclassified, you could be losing out on a lot of money. And it's really hard to go back years and years to get these things undone. You can usually go back to the prior year, but your agent needs to know how to do that and why it should be argued for a different code. Okay. So you can see by being misclassified in both scenarios, you can pay an extra 30 grand. You could pay double on your workers' comp or more. Okay. So it's important to, have somebody who understands your business, understands your state, and is willing to fight for you in these situations. Again, these have different risks. Okay. That brewery code is really like they're looking at like Yingling, Heineken, right? Somebody who is producing mass beverages going out the door, no on-premises consumption, that sort of thing. But each state's going to have their own definition. Hopefully that clarifies classifications and how you are priced. Your rate didn't change. Okay. You're either misclassified, has a different rate. Multiplier is a rate, right? The rate. It's important to classify that stuff correctly. Okay. Your rate didn't change. Your exposure changed, right? Your sales or your payroll. We consider those exposures. Again, I mentioned that manufacturing companies are based on sales exposures. A warehouse, right, or a beer garden, that might be based on square footage area. A grocery store could be based on sales. A grocery store could be based on square footage. A contractor, a lot of times, is going to be based on payroll and the payroll of their subcontractors. They're going to do it differently for every type of class of business. Okay. And that's why when, maybe you have an insurance agent who doesn't work on a lot of manufacturing accounts at all, doesn't realize there's these different nuances. It could lead again to overpaying, which over time could help you not get the equipment, not expand, not get the vehicles, not buy the equipment that you could have. Now, you went through your policy year, right? And you were misclassified or not. You have to do an audit. An audit is typically 90 days after your policy ends. All right. So if you have a May 1st policy, 2023, you're going to come up to your May 1st renewal here in 2024. And then that window of the next 90 days, May 1st to August 1st, is going to be your period. Well, someone's going to reach out and go, hey, we're going to do an audit. Maybe they do it in person, maybe do it online, maybe you do it yourself and upload it. That's also where you can get misclassified because you may not know and understand the codes, right? For like the wholesale keg code, it says beer not bottled and not canned. Okay, so what does that mean, right? So then that can be draft, that can be kegged, poured through a draft. Those things matter. Okay. So an audit, we come back to the whole contractual thing. All right. These are contracts, right? So in your policy, under the conditions kind of lay out, you do this, I do this, business owner, insurance company. We will compute all premiums for this coverage part in accordance with our rules and rates. The premium shown in this coverage part, so this might be property or this might be general liability or liquor liability. In this part, this is the expected premium based on the exposures you gave us, right? At the close of each audit period, we will compute the earned premium for that period, okay? The first named insured is the business, the first name on that bill that comes in the mail. The due date for audit and retrospective premiums is the date shown as the due date on the bill. And you're always going to be audited on the policy dates, May 1st to May 1st, June 14th to June 14th, right? It's usually gonna be 12 months. It's gonna be when you started the policy. It's not December 1st to January 1st or something like that. It's gonna be the dates of the policy. That's always the audit period they're looking for. And you may have fluctuations in your business, right? January, February, March might be terrible. So therefore, you don't want to do like a rolling 12 months because it's going to be inaccurate. Or you might take your busiest months and it could, again, misclassify or something like that. If the sum of the advance and audit premiums paid for the policy period is greater than the earned premium, we will return the excess. So, hey, we said we're going to do 2 million in sales, 500 on premises, 1.5 going out the door. You did 400 on premises and 1.3 going out the door. Okay, so it's at 1.7 instead of the 2. They'll return you money. Okay. The first named insured, but obviously the opposite. If you did 2.2, well, you'll owe the difference. The first named insured, you must keep records of the information we need and send us copies at each time as we may request. So they're really looking for P&Ls. They're looking for financial statements, maybe tax returns. Some of the software is great at this. Some of it's not. And again, it all comes back to, did you separate cans going out the door, bottles going out the door versus things consumed on premises? Here, I thought this was a little more appropriate. This was later in the policy. This is from a real policy. The estimated premium for this coverage form is based on the exposures you told us before the policy. We're going to do 2 million in sales, 500,000 on premises, 1.5 going out the door. We will then compute the final premium when we would determine your actual exposures, right? Estimates versus actuals. The estimated total premium will be credited against the final premium due, and the first named insured will be billed of the balance, if any. The due date for the final premium or retrospective premium is the date shown on that bill. If the estimated total premium exceeds the final premium due, you'll get a refund. It's funny how they don't say, well, if the other way, you owe us, but you do, right? So it always makes it sure. It shores it up. They don't audit every year either, but for the most part, they will. We having fun? All right, so I paid all this premium during the year. Now they want more. What the hell, right? Hear it all the time. So again, on the start of the policy, it's based on the estimates. We're going to do 2 million. End of the policy, we did 2.2. We're going to do the audit. We're going to obtain those actuals. You're going to owe or get money back. Why do they do these audits? The canned answer is to make sure the information they have on business is accurate. Otherwise, they may not be compliant with the law of their states. That's true, right? But also really to collect enough premiums to meet the reserves, to remain solvent, to pay claims in the future and futures to come. Right? If they're collecting premiums on a bunch of breweries that are doing $1 million, but that say they're doing $1 million on paper, but they're all doing 10 million, well, are they going to have enough money to pay out these claims over time as these folks grow, right? start to, that means that you're also going to have more vehicles on the road, more employees, and probably more injuries, right? And more claims in general. So we need to collect those premiums. We want them to be accurate. Let's go through another example here. So in 2023, estimated sales on the policy were $1 million, right? That was $10,000 in premium. Actual sales were 1.5. So just for easy numbers, that's an extra $5,000. Okay. So you did 1.5. Originally you paid your $10,000 for the year based on $1 million in sales. You did 1.5. The audit comes back. You owe $5,000, sir, lady, all due at once in a lump sum within 90 days of the policy ending, just after. Right. So this becomes a problem, right? That $5,000 is owed all at once. You probably just had your renewal and probably paid like a 25% down payment. So now you're like, all right, we already just dumped a bunch of money in and now we owe more. We don't have it, right? It becomes a problem. Now, a lot of times these insurance policies, your last 2 or 3 months of the year, you didn't have a payment, right? You might have had like a 9 or 10 pay. So that's where you're like, all right, hey, we need to make sure. And that's where we reach out 90 days before your renewal going, hey, renewal's coming up. Be aware you have a 25% payment. If you don't have any payments right now, save that money, right? And it may be a slow season. This always, you know how it goes. This always happens in January, right? Renewal plus audit bill. We don't have any income coming in. What are you going to do, right? Again, it says it in the contract. Okay. I know it sucks. I know we don't really read them. Maybe you do, but it's a contract. The insurance company said, hey, we're going to give you coverage. You said you're going to pay them. We're going to do an audit. We're going to collect it. So it's in the contract. All right. So your real premium based on $1.5 million of sales was $15,000 for the year. Now, here's also what then happens. 2024 rolls around, right? You renew your policy with your agent. Agent never changed your sales. Okay. Still $1 million on the policy. Your premium's still 10. Right? You just keep rolling, right? No one's paying attention. Well, now you do 1.8, right? So you went from 1.5 to 1.8, but your policy says you went from 1.8, from 1 million to 1.8. Now you're going to owe $8,000, right? Instead of, it could have been 1.5 from based on the prior audit to 1.8, right? That's a $3,000 owed. Or your agent 90 days before said, hey, what are you projecting this year? And I said, hey, 1.8. Okay, well, we have 1.8 on the policy. We get 1.8 in the audit. We don't owe anything. You might get money back if you were a little below, right? So we want to pay attention to those things, right? This needs updating annually. It needs to be, you need to be communicating with your agent 90 days before renewal. If you're not getting an email or some sort of ping prior, you need to, pay attention to that, right? You need someone who is, I see Adam Keel. Insurance, yes, it's fun. We're gonna like it more. All right. So again, we need to be talking early with our clients, myself included. All right. I have kind of come up with a little way to combat some of these audit situations. And that's 5 months into the policy, we're doing a midterm review. We make changes. So say, hey, there was only $1 million on the policy. Whoops. Hey, we need to make that 1.8. We make that change halfway through. And now the remaining policy payments, it's a little more, instead of a lump sum. All right. We're able to make that change and spread that out, right? Cash flow, predictability. That's always my goal. You didn't do your audit. You get this nasty gram in the mail says you're non-compliant, right? That means it wasn't done. You're going to get an invoice then for double the premium, right? It said $10,000 is what we paid. They're going to send you a bill. Hey, you owe 20. You're going, what the hell? Why do I owe 20? I didn't do that much in sales. They assume that you're not completing the audit because you grew so much and you didn't want to pay them. All right. So it's also really just a way to get your attention for you to go, hey, $20,000 bill. Where'd this come from? Okay, so what we do then, right? We really want to just complete the audit. Probably insurance agent has to go, hey, we are disputing this. They're completing it. We're in touch. They were unaware. They were out of town. They didn't get the mail. Something screwed up. Work with them. Be patient. They're working on it. Okay. So that's where a lot of times I have to kind of smooth that over with the auditors going, hey, listen, they were out of town. They had something happen, whatever. They missed it. Life happens. They're working on it. Let's get an extension here. Let's get it done. How can we do it? What do you need done? They can cancel the policy, all right, for not doing the audit because you breached the contract. So you're still going to owe it, all right, because the insurance company gave you the insurance and you used it. Okay. So you're still going to owe it. You don't pay it, goes to collections. Doesn't look so good. Okay. That becomes a whole other headache. If sales and payroll were lower than the estimates, once you do, like, you might get that bill for $20,000 and you're like, hey, I didn't do that much in sales. Okay, we'll do the audit, right? So then you do the audit and you didn't do that million in sales. You did 940. Okay, well, maybe you get $60 back or $600 back, right? They will return that to you. So it does, if you did less, it definitely makes sense to do the audit. You'll get a couple dollars back. So there's kind of two ways when that money comes back. They can pay it forward into your new policy, your current policy, or they can cut a check to you. Next slide, please, to myself. Okay. Hopefully that clarifies a little bit. I'm sure, listen, this isn't going to be the most exciting part of your day, but again, you have to do it. Might as well know what's going on a little bit. Coverage triggers. What triggers coverage? Nothing's ever covered, right? We file this claim, nothing covered. Well, there's triggers, okay? And it also always comes back to what happened first, okay? What was the first cause of loss? And we call that the proximate cause. Why did the claim happen? Is it a covered cause of loss? What does your policy say is a covered cause of loss? Did you read your policy? No. If you went to court, judge is going to go, did you read the policy? No. Well, you signed it. Yeah. Well, I thought that he took care of it. Did you read it? No. So got to read the policies. If you have a question, let's read them together. I do it a lot. Flood is typically excluded. If flood caused damage to your building or you to close or knocked out your chiller, flood's excluded. Flood was the proximate cause. Everything that flood caused is excluded because the flood caused it and the flood was excluded and the flood was the proximate cause. If you have wind coverage and wind caused the damage and wind is included, well, now we should have coverage, okay? Domino effect happens when we have down chillers, when we have wind. We lose power, chillers down, beer gets warm. We can't open, right? So we lose income, we lose electricity. We might have spoilage. We might have contamination of our beer. Our beer might get warm. We can't sell it. We already sold it to wholesalers. There is a trickle down effect, okay? So what happened first? Read your policy. Just, I know you're probably not gonna. It's not fun. But ask questions. What I like to do, what you can always do is go to one of the first pages and go, it shows you a list of exclusions. Go, what are these things? And usually, like flood, they're excluded because there's a better way to cover them. There's probably a separate flood policy that you could purchase and cover that, or wind coverage if it's excluded, or fungi coverage if that's excluded, right? So a lot of times we can buy these coverages back. It doesn't have to be a crazy expense, but they're excluded because there's a better way to cover them. So ask about that. Go through these. Hey, can we buy that? Hey, that sounds like a concern. Yeah, that bothers me. Can we buy that? Is there an option for that? It might cost you $37. Ask. Coverage triggers. Okay. We talked about some damage there. Bodily injury. Okay. The word liability really means bodily injury and property damage to others, right? So when we have general liability, we have liquor liability. We're talking about our coverage if we harm others physically, if we harm others, if we damage their stuff, okay? So even food poisoning is considered bodily injury, okay? Physical damage. You drive your vehicle into someone's building. You drive your vehicle into someone else. You run your dolly into someone's plate glass window and smash it, right? There are physical things that can happen. Damage will trigger coverage. If it's intentional damage, it will not. If you meant to do it, no coverage. Got to read the policy. Temperature change, right? Why did the temperature change happen? Was it wear and tear of the chiller? Probably not covered. Okay, wear and tear is never going to be covered. That's kind of a maintenance thing. And guess what? You're probably 2 months out of your warranty and you got to go buy a new one. Okay. Wear and tear is not covered. Temperature change can trigger spoilage, but again, what happened first? Equipment breakdown. Why did it fail? Right? It's new. It failed. A lot of times that's covered, but why? Why did it happen? Here's one of the first things that I learned about covering physical damage. Wharves: wind, hail, airstrike, riot, vandalism, explosion, smoke. Those are coverage triggers, assuming they're not excluded on your policy. Okay. Hey, Philly's wilding out. They're rioting. Do I have coverage for my stuff? Yeah, theft, right? If you have theft coverage, right? So what's excluded, what's not, right? What's included and what's not. A lot of times, a judge may say, hey, it's not excluded. We're going to give the coverage. We're going to honor it. So there's lots of case studies. There's insurance is fun, I'm telling you. But a lot of times, if you're near the coast, you won't have wind coverage. Okay. You can go buy extra wind coverage. So these are just kind of rule of thumb. Again, your policy may be very different. You may not have any of these coverages, right? It's good to review. Be happy to help. All right. You must purchase these coverages in order to have coverage. Again, so these are typically excluded on your everyday policy, right? Cyber liability, absolute cyber exclusion, right? Even liquor exclusion. You got to buy liquor liability. You got to buy the cyber coverage, right? If you have a data breach, you might not have coverage because you got to buy a policy for that. Or you can add a little bit onto your policy. It's better than nothing. Employee wants to sue the employer, right? Sexual harassment, wrongful termination, failure to hire, failure to promote. You fired me because. That's an employment practices liability type of policy. Again, you're going to have that employment-related practices, employment practices liability excluded probably right up front of your policy. In order to get that coverage, you got to buy it. Again, it's better covered on a separate policy. Now, again, you can get some throw-ins that are added on. Might cost you $200. It's better than nothing, but it's only typically, a piece of what you really need. And these things don't have to be crazy expensive, okay? If you have higher on-premises consumption, your insurance is going to be higher, okay? It may make it hard to purchase some of these coverages. Flood, excluded, right? You got to buy a flood policy. Contract breach. This is non-tangible. All right, so this is, hey, there was no physical damage, there was no bodily harm. So the trigger for this would be a breach of contract. Okay, in order to typically have this coverage, you would need a directors and officers policy covering the directors and officers of the business. Okay, because they didn't follow through on the contract. If you have a bad product, a mislabeling thing, you need to bring your product back from the marketplace. Product recall policy, product withdrawal expense. There's a couple of different ways to do it. Again, but you always want to try to, if you can afford it, quote it out, buy a new policy separate for that situation. Death, right? How do we cover death with a life insurance policy? Okay. Key person life insurance policy. We want to get an appraisal of the business, talk to your attorney. We want to have a cross purchase or a buy sell or operating agreement put together for our owners. The value, say you have that, the value of your business when you started is not the same as it is today. Okay. Life insurance policies are very important. We do them all the time. They're very important for, in those operating agreements. Hey, we took out all these loans. We have a partner who doesn't want to be a part of this anymore, or we have a partner who passed away. Now that means that their spouse is going to step in and now as a partner. Do you want to work with that person? Do y'all get along? Does that person want to be involved, right? Those policies, the life insurance policies and operating agreements will dictate who does what. You can use that life insurance policy to buy out that share. That spouse goes on their merry way. You bring that money in, right? You bring that equity into the business. Other issues and solutions. Last minute renewals. I always feel stuck, right? I get it 3 days before renewal. I feel stuck. Okay. Big down payments. They canceled my policy. These inspections are out of control, lost control. They're coming through my building. What are they doing? Okay. Kind of solutions for some of these last minute renewals. We're pinging you 90 days early. You may not return your document until 3 days earlier than the renewal. 87 days went by. You're going to get a last minute renewal. Okay. So it's teamwork here. 25% down payment. Like I said, plan ahead. You probably have 2 or 3 months before that where you didn't have a payment. Okay. Stash that money. They canceled my policy. So, even my insurance agent canceled my policy. Only 2 parties can cancel an insurance policy. Okay. The insurance company or yourself, right? Say, hey, I don't want it anymore. Sign, cancel. Hey, I didn't pay it. The insurance company cancels it. Hey, you were not compliant. The insurance company cancels it. I, as an insurance agent, cannot cancel a policy. I like when they cancel my policy. Like, well, what really happened? Inspections and loss control, get them done. The audits, get them done, right? They need to walk through your space to make sure that it's safe. They're looking at wet floors. They are looking at shaky handrails. They're making sure that your fire extinguishers are tagged. The person might be really cool. They're on your side. They're going to help you out with making sure you're safe, right? They want you to be the client. They want you to be there. They want to come back there for a beer another day, right? So, work with them, get them done early, right? You may have to put in some work. You may have to go get the sprinkler or the boiler checked. You may have to get all new fire extinguishers. You may have to get a divider on your, kitchen equipment. Okay. It's all for safety. They're on your team. Again, the contract, it's an insurance contract. It says all these things. And when you sign it and when you pay it, you're agreeing to it. Again, leave time, right? Again, that renewal. Yes, lots of insurance companies are dropping clients in California, right? There are no, State Farm and Allstate no longer writing business in California. Homeowners in Florida, they're without insurance. It's becoming very expensive, and we'll talk about the catastrophic claims here in a moment. But good stuff, Adam. Thank you. People, not computers, are handling your renewals, right? So give them time to do it. Other reasons for rising costs: social inflation itself. Litigation funding is a huge one. Catastrophic events are huge ones. Litigation funding means that there are more claims going to court, all right, that weren't before. All right, so hey, I don't have the money to pay an attorney and go to court and fight this, right? So tens of thousands of dollars, if not more. There are investors going, we'll pay for that. If this claim gets paid out, we take a cut of that. So claims that were 600 grand or maybe even weren't going to court are now 1.4, right? 2.8, right? They're being called nuclear verdicts. Catastrophic events, real quick. California and Florida, I just mentioned, right? They're exiting those states. Many property insurance companies are going bankrupt. We saw during COVID, lots of insurance companies, property insurance companies in Florida, they're going bankrupt. Many homeowners now, hey, we can buy it for a price. They're going, we're not going to pay for that. So they're self-insuring, right? The average catastrophic event annually, all right? The average 1980 to 2023, okay? So there were 8.5 $1 billion events every year on average from 80 to 23. So for 43 years, about $8 billion events a year. I know we don't have a ton of people in the chat, but how many do you think there were in 2023? Okay, we went from 8 a year for 43 years. Climate change is real. In 2023, there were 28 $1 billion events, and still counting because we don't have all the data from like November, December yet. 28 $1 billion events. These insurance companies are paying that out. That's why they're collecting that premium. That's why they're doing the audits. That's why they want to be here for 100 years. Okay. 17 severe weather or hail events. That's roofs. That's cars. I mean, that'll total a car. That'll all new roofing and siding. Think about that. 4 flooding events, 2 cyclones, 2 tornadoes, winter storm, cold wave event, wildfire in Maui. We still don't know the value on that. A drought and heat wave. Those are crops. All these things are trickle down effect. Here's what the insurance market's looking like for 2024. If you haven't had your renewal yet, if you're in a safe area, no catastrophe area, you're still going to get a 5 to 10% probably increase on your property. What they're also doing is increasing your property values because we think it's going to cost more to buy those things than it did 5 years ago. All right. If you're in a catastrophic area, prone to tornadoes, wildfires, hurricanes, you're going to get a 15 to 25% increase on your property insurance. It's almost becoming, again, like Florida, unaffordable. General liability, taming a little bit, 1 to 10%. Auto, we don't know how to price this. Windshield used to be $500. Now it's $2,500 at least. Okay. That's the most common claim in all lines of business is auto. You're seeing 5 to 30% increase even on your homeowners and auto, right? Your personal. Workers' comp coming down a little bit. I saw like a 15% decrease on one of my policies today. Cyber, 0 to 15. I saw a decrease on that today too. But we are seeing that last year was 100% increase. So now it's coming down a little bit, figuring out how to price it. But cyber attackers, they're not going away. Directors and officers, I mentioned that. Breach of coverage or breach of contract, 0 to 5%, negative 10 to 5% for a public company. Employment practices liability, 10 to 10%. We're seeing more and more of those claims as we saw that reckoning through the industry, right? So those aren't going away. My solution, 4 ingredients to a better insurance experience, right? We make beer, okay? Water, barley, hops, yeast. What do we get? We get a predictable, delicious beer, usually, right? So what happens when you get somebody who has access to the insurance carriers with niche specific coverage, right? Brewery specific coverage, who has the added knowledge of a certified insurance counselor, the extra exams, understanding of an insurance policy, has worked in the industry, has the experience and the resources, member of many guilds, insurance carrier options with very good relationships with underwriters, and a plan throughout the year to contact and speak. That makes your insurance predictable. That's what we strive to do at Arthur Hall Insurance. My goal is to be in communication. I don't like surprises. You think I like redoing those audits and things like that? No. So over the last 12 years, 13 years, I have kind of developed a way to make this easier for everybody, make it understandable, make it predictable. Any questions you have, scan that. And I got some more slides, but scan that CBP. Yeah, CBP, Craft Beer Professionals 24. I did this late at night. But email me, hey, Kyle, I have a question on this. Hey, can you do a review? Hey, what are your thoughts on? I'm happy to help. I can give you recall templates. I can give you emergency planning documents. You got employees get injured. We want to get them back to work. I'll give you, return to work programs. Hit me up. Okay. I'll see you in Vegas. I'll be doing the Huddle Brewing and Abel Baker party on Sunday with Andrew, Craft Beer Professionals. It's going to be a lot of fun. See you in Vegas. Tune into the Beer Mighty Things podcast. Wherever you find a podcast, you can go find it, search it. You can scan that. It's good. 26,000 downloads, no promotion, at least no dollars spent on promotion because I'm promoting it now. That's me drinking a beer. I like it. One of my favorite things to do. Please call me. I'm here for the industry. I'm not going away. I'm happy to help. Kyle at craftbrewinginsurance.com, craftbrewinginsurance.com, 657 beer insurance. That's my phone number. That's pretty cool. Instagram, Beer Mighty Things podcast. Let me know how to help. We are here. We appreciate you. This is the greatest industry. And the goal is just keep on providing value and answering questions. So I appreciate you. That concludes my program here. Y'all have a splendid day. Cheers.